again, if you'd like something a little bit more specific to your situation, feel free to reach out to us. Okay? And so with that, we'll go ahead and dive in. Probably question on a lot of people's mind are, what's going to happen next? And the short answer is we don't know. And so I want to remind everybody of that before we get into trying to provide some information and some insight and maybe some things to be looking at as we go forward. But it's very clear that, it's difficult to predict what's going to happen in the future. We're going to go ahead and jump into the slideshow here. So I'll just have you interrupt me if for any reason you detect a problem on your end with seeing the slides move, okay? All right, so let's begin with just a real recap of where we are on the coronavirus and cases of COVID infections and deaths. I think it's pretty clear as we follow this that the economic opening and the market behavior going forward, one of the primary components of those future behaviors economically and market-based are going to be what's happening with the virus. We need to control this virus and have a pretty clear picture of what's going to be happening going forward in order for us to be able to act with confidence in the markets. And so first things first, just kind of recap where we're at. I think that the happiest piece of news out of this slide showing the 7-day average daily change in confirmed cases is that we've got flattening and in some cases decreasing curves across just about every country that we're tracking on the slide. You can see the US at the top in red, having reached a flattening point here in new daily cases. Tracking really closely the Johns Hopkins website. If you haven't been on there and you're interested, that's a fascinating place to track what's going on with cases in the U.S. Right at the moment. Per Johns Hopkins, we're up to 749,666 cases across the country and just over 35,000 deaths. The happy news there is that we are, as this slide shows, in a flattening place. There is some data here on the purple line that extends out farther because the bottom axis is showing the days since 50 daily cases were broached. In the case of China, that was longer. In terms of the magnitude and the trend that you can see, also South Korea here. Both China and South Korea have had very aggressive shelter-in-place restrictions put in place, and you can see the dropping number of cases. The expectation is that if the U.S. continues with its shelter-in-place guidelines, we'll see hopefully similar drops in number of cases going forward. And the big question that's in the news is, how soon is it to start to relax? The consensus from the health officials seems to be not yet, but a lot of debate, both in terms of public health and in terms of politics, around when to begin to relax. Talk about that a little bit more as we go forward. Here's the same slide, but showing deaths. You can see that the death information follows the new cases information, and the expectation here in the U.S. is that we've just sort of come through the peak. Nationally, New York City about a week ago, it appears we were at the peak. Some places moving past the peak in the U.S., and unfortunately, there's some other places that have not yet reached the peak. It may be the case that that's true for Northern California. Certainly, some of the inland parts of the country, and particularly those that were slower to adopt shelter in place, may become hotspots going forward. We're watching that really closely. One of the big areas to note impact potentially in some of the interior parts of the country is that a lot of the food supply for the country is produced in some of those places. You may have seen Smithfield pork facility shutting down. There were a couple of chicken facilities shutting down. That will translate pretty quickly to availability of those kind of products on grocery store shelves going forward. And so we're watching that pretty closely. Just a quick look at some hotspots here in the U.S. Broken out by state. You can see New York as sort of leading the pack in terms of number of cases, New Jersey right behind, and then a bunch of states clustered after that. Washington was out of the gates early, but has seen flattening. And if you can see the dotted lines here showing the slope of how many days it takes for cases to double, we are now in just about every state here flatter than the every 5 days. We're looking at every 7 days, or even perhaps moving into a week and a half, 2 weeks. That is the direction that we want to be going. So what are the things that the market is looking for in order to feel like we're back on solid ground? Well, we think there are three in particular, and probably there's a number of subsets under each of these, but important ones to note. Started with the virus, because control of the spread of the virus is the first factor, right? I don't think we're going to feel good about celebrating economic news, chances of recovery, until we feel like we've got a clear understanding of the spread of the virus. It's not only where it's growing and how much it's growing, but also that the shelter-in-place guidelines are working, that the policy around loosening shelter-in-place has been thoughtfully and appropriately managed to prevent reoccurrence. You can see that's the second point here. The prospects for a second wave later in 2020 or into 2021 is another thing that the market is going to be looking at really closely. If we take the foot off the gas, so to speak, too early on coronavirus shelter-in-place guidelines and cause a second wave of 6, 8, 10 weeks of lockdown later in the year, that is not going to be well received in markets, and it's going to be something that we expect potentially will be worse than another week or 2 or 3 or 4 of shelter in place now. The third one here that the market's going to be looking for is the impact of shelter in place directives on economic activity. Obviously, that's a big, broad category. In particular, I think markets have been responding positively since lows of March 23rd to the fact that the Federal Reserve has come out to shoot its big guns, right? You might have heard the term bazooka. Basically sending the message that we're going to do everything in our power, whatever it takes, to help the economy continue to function and markets continue to function, and also fiscal policy. Big package came out a couple of weeks ago, 2.3 trillion, direct payments to individuals, the PPP for businesses, some tax relief, other pieces coming out from the state of California, and of course countries across the globe as well. Both central banks and fiscal policy across the globe have been very aggressive and large in magnitude, much quicker response than what we saw in 07, 08. I think a lot of lessons were learned. One of the big questions is out there on this third point of the impact is that the longer the shutdown and shelter-in-place guidelines stay in force, the more difficult it is for fiscal and monetary policy to sort of plug the gap in incomes and in the flow of cash through the economy. And I think the market right now has priced in continuing to shelter in place through early May, perhaps to mid-May. If we're going to push it out longer than that, to Memorial Day or into June, then potentially there's going to be some volatility and some vibrations in the market. The idea that not only for that extended period the economy is going to suffer, but also that it's harder for the economy to come back the longer it's down, right? Direct payments to individuals, PPP, designed to get us through a few weeks. In the case of PPP, 8 weeks. The longer that we go beyond that window from mid-March through mid-May, the harder it is for the government to bridge this gap. Now, we did see last night that it looks like we've got a deal on Capitol Hill to extend the PPP funding for an additional 250 billion or so since the original 349 billion ran out last Thursday, and that will certainly be welcome. But again, there's a sort of a timeline on what we can expect the government to be able to do to keep everything flowing. The other thing I want to bring up here is that if there are changes in the timeline, either bringing them sooner in time or potentially they take longer than expected to get to widespread testing, a vaccine, treatment, or understanding that herd immunity has been widely and broadly built across the globe, that could make a material impact of what market expectations are. It's pretty clear that in order to open up the economy, we need to be able to count on the availability of testing and quick test results so that when we do have individuals that become infected, they can find it out, isolate themselves, and track the people that they've been in contact with and have them tested as well, and have all of those people go on self-quarantine on a more targeted basis rather than this broad-based shelter-in-place that we've got going now. Until the testing is there, both in terms of availability and in terms of quick response, it's going to be difficult to have that targeted case-by-case management. And so that is a big area for both the public sector and the private sector to focus right now to get this testing capability established. And I think probably many of you have heard about the opportunities to build a vaccine, taking 18 months, probably potentially 24 months, in order for that to be not only proven, but also mass produced such that it could be widely distributed. And so we're looking to be well into 2021 before that's even a possibility. Questions about treatments that could be brought online sooner than that. Any good news on that front will certainly be well received. And this last point I want to make a moment to mention around herd immunity, this idea that people have been exposed to the virus, built up antibodies after having defeated it, and are now no longer susceptible to being reinfected. There's still a lot of science being done and a lot of studies being done, but there are some schools of thought, some coming out of the Netherlands, also out of Stanford, on this idea that perhaps more people have caught this virus than we realize and are asymptomatic and have potentially been spreading it to other people, but also have been building up antibodies and would be immune going forward. If it turns out that the building of herd immunity is much quicker than we're currently expecting, that would be a positive thing in the markets as well. Real quick here before we get into some market data, the federal government came out late last week with a recommendation on a phased opening of the economy. It's definitely going to be up to states to adopt this, adjust it, and also kind of how they're going to manage the timeline. But the basic idea here from the federal government is to establish some gating criteria that all states or regions would need to meet over a 14-day period before they can move into the phases that follow. And you can see here some of the opening that would happen after passing from the gate criteria to phase one, and then another 14 days of continuing to satisfy the gate criteria would allow that state or region to pass to phase two, and then another 14 days will allow them to pass to phase three. So even if we pick a date, look at May 11 or May 18 as a time to return to more normal behavior, our expectation is going to be that it's going to be phased in over time, and there are going to be certain sectors of the economy that are going to be more impacted by this limited opening. Some businesses will begin to participate and act more normally, more quickly. Others will still be pretty slow to get back, and so we'll get to that as we go along. Just want to provide a little historical perspective here as well on U.S. equities. Here you can see the S&P 500 index starting from 1996 and the end of the run late in the Clinton administration through the dot-com bubble burst in early 2000. You can see the trough, then back to a peak in the fall of 07, the trough March of 09, and then a substantial run up from March of 09 until February 19, 2020. Almost 10 years, almost 11 years between that trough and this most recent peak. And I just want to give a little context, right? Because although we dropped pretty quickly in the S&P, already with the bounce back that's happened, we're down, updating this number actually about 14% now. The S&P 500, substantially less fall than either of the previous drops, the dot-com bubble burst or the Great Recession, financial crisis of the following wave. And so just want to put that into a little bit of context. Here's a look at the stages of a sell-off, and this COVID sell-off in particular. You can see the dates at the bottom of the slide and sort of the level of the S&P 500. One of the things that was remarkable about this downturn was the speed in which we went from peak to what appears to be a trough, or at least an initial trough, in less than just about a month, from February 19th until March 23rd. Rapid fall off over a very short period of time. Unusual to see it go that quickly. And then some questions as we came off of that bottom about whether we would go back down again. And our thought is that very likely it could happen, that we could see some downward movement again, although we're not feeling particularly strongly that we're going to see that low spot like we saw on March 23rd again of S&P at the 2200 level. But we'll get into some of the reasons of why that's the case pretty quickly here. Real quick look at some past setbacks and rebounds since the end of the financial crisis in 08-09. Here you can see the 2010 to 2020 trajectory for the S&P 500. And notable that we've had turndowns like this since the financial crisis, right? You can see concerns about Greece in 2010 and again in 2011, driving mid-high teens downturns. Then fourth quarter of 2018, just a little over a year and a half ago, almost a 20% downturn in the S&P 500 from October 9th until Christmas Eve of 2018. And this one here, although certainly sudden and the bottom was lower, such an immediate bounce back, the net effect over a short period of time is that we're, not that far out of line with what's happened in the past. I just wanted to call some attention to that. I think there's certainly some reasons to think that this circumstance is unusual, given this lingering viral threat. But as far as markets are concerned, we've seen things on this order before, and I just want to remind people of that. I think it's easy to take away that this one is the worst ever because it's the recent one that we can remember, but there's evidence to suggest that we're not that far out we've seen before. This slide has got a ton going on. Just show some past bear markets, right? And noteworthy here to sort of see that the current bear market is both, not in record-setting territory in terms of the depth of the market decline, and also the key thing here is, at least at this point, it's very new and its duration is still pretty young. And so we're going to talk about the potential shape of the recovery, but I think it's important to understand that we've had bear markets that have been both deeper and longer in duration than what we're seeing here. And again, that's some helpful context. Here's an interesting slide that shows all U.S. recessions on record. And interestingly, two of the shorter ones in history, going back to the 1850s in the U.S., were associated with pandemics. The Spanish flu pandemic of 1918, did a little research on this. If you haven't checked it out, it's an incredible set of stories. 50 million people dead was the estimate from that flu pandemic a little over 100 years ago. 3.3% of the world's population. I mean, that is incredible. Something on the order of 500 million people were infected. Today, with a world population of 7.8 billion, if we had 3.3% of the world population pass away, that would be 257 million people. Right now, we are, currently working on, total deaths measuring in the tens of thousands, moving into the 100,000 range. And so, just 100 years ago, a dramatic event. 7 months was the length of the recession that corresponded with that. And then this forgotten pandemic of 1957 was an Asian bird flu scare. 100,000 deaths, perhaps, maybe a little more. But again, similar type of a shock to the system, and one of the shorter recessions that went along with that. You can see here that most years where we've had a downturn that touched into the negative 30 category, like we did on March 23rd, have not been positive years overall in the stock market. What this graph is showing is where the lowest point intra-year was in the red, and then in the black bar where the market finished for that year. You can see in past occasions when we would hit into that negative 30s territory, it's often not been a positive year. One notable exception, 1987, Black Monday, the stock market crash in October of 87, the market touched negative 34% around that time and actually finished up 2% for the year. And I just wanted to highlight that. Next slide shows the 1987 crash with the 2020 COVID crash layered right over the top, 1987 on the left scale, 2020 on the right scale. Interesting parallels, much different time, much different place. Not necessarily, going to continue this close tracking. Certainly no causational effects here. But interesting to notice that at that time, a shock introduced in that case around programmatic trading, different motivation, caused the market to drop quickly and then rebound. Certainly not back to its previous highs very quickly, but also sort of showing that there was recovery. So I thought that was interesting to call attention to see if that will continue to track. I mentioned the central bank responses have been massive. You can see rapid dropping of overnight interest rates and expectations for them to remain at or near zero for the foreseeable future. And not only that, but all the policy actions that you can see here, creating lubrication and a buyer of last resort for the kind of securities that are necessary in order for credit markets to continue to function. Here's the Fed's balance sheet. Historically going back to the 07-08 was in the 2 trillion and below neighborhood, spiked up over 4. Previously, when they were buying distressed securities in 07-08, dropped back a little bit lower here in late 2019, and now we're heading for new territory unseen before. The Fed basically buying things in order to keep markets functioning. It's possible that we'll go, not only north of 6 where we're headed right now, but all the way up to 10 trillion, which would be more than double the previous record. So the Fed basically stepping in and using their ability to control the supply of money to buy things. One point on oil really quick, important to mention here, and actually pretty incredible what's going on even today. I was just looking in markets as we were preparing for the call, and West Texas Intermediate crude, which is the U.S. Crude, has actually dropped down to just below $4 today. When I was checking it last night in advance of the presentation, we were in the high teens. This is record territory. We dropped $14 just today. Interesting, Brent crude, which is the Europe, Middle East, Asia standard for crude, is holding a little bit steadier at 26.48. And so, I think what's driving this in particular in the U.S., this Texas standard for oil, is a real concern about lack of storage capacity. The oil being produced in the world is outstripping demand in this coronavirus shelter-in-place world so rapidly that we're running out of places to store it. And when that happens, you get to a point where basically people won't buy it from you because they don't have anywhere to put it. And consumers are not putting it in their gas tanks and running their factories. And so we are rapidly reaching a point where oil prices are in the case of West Texas today, I mean, this is unprecedented, moving down towards $4. That's for the May contract. I did see that the June contract is quite a bit higher. And so there's some short-term disruptions that are actually happening this morning as I was preparing for this. The important point to take away here is that there's going to be major pain for drillers and producers in the United States, certainly, who need prices in the high 40s in order to break even. And so currently $4 compared to 40, that's not even close, but even where it was just a few days ago around $20 is going to be a recipe for a lot of producers to go out of business here in the short term. You can see at this bottom left chart in the blue, the number of active rigs in the U.S. You're up over 1,000 before the oil price tanked in 2014. And it's been sort of steady here, right at 1,000, but I'm sorry, about 600-700, but heading down below 500 very quickly, given the current prices and their inability to hold on, given their break even is so much higher. Saudi Arabia and Russia, a little bit different situation. Saudi Arabia probably has the cheapest oil in terms of producing it. They can break even at in the mid to low teens, so they're doing fine with the Brent price. Russia not so much. They need prices in the 30s or 40s in order to do well, and so there's going to be some pain across a number of oil-producing economies going forward. We're going to be watching this one closely because this is a major commodity and big disruptions in the supply chain for oil going forward here. Moving on here, I want to be sensitive to time. This is a really interesting slide that shows the most impacted industries in the U.S. By the shelter-in-place directives, right? So you can see we've got retail minus food and beverage, and then food and beverage, entertainment, airlines and cruises, and hotels and tourism. This is a subset of economy, of sectors in the U.S. economy. Together, they represent about 19% of consumer spending, 19% of GDP, 20% of payroll jobs, but only 7% of earnings. And so the point here is certainly important that there's going to be disruption to these industries. Feel terrible for folks losing their jobs. But as it relates to the earnings, which is one of the underpinnings of the market pricing of the S&P, lower impact by earnings than it is by percentage of spending or by payroll. So interesting to see the market not taking as seriously the unemployment claims number, which have jumped incredibly over the last 4 weeks. This could be one of the reasons why. It's just a smaller component of earnings than it is of jobs in this country. This chart, amazingly, is already out of date. It's April 15th here at the bottom of the slide. We expect that the unemployment rate in the U.S., which bottomed at about 3.5%, could hit north of 20% here for at least a short period of time. 22 million jobless claims in just the last 4 weeks, people applying for unemployment. That's unprecedented. The highest week ever in the history of the country since they started tracking it prior to this was 695,000. And then we had 6.6 million in 1 week, almost a 10 times spike. That's incredible. The speed in which payrolls adjusted to this changing conditions, I think that's partly due to our connected internet world that we're living in, but still unprecedented times. Could see this unemployment factor jump north of 20%, perhaps even to 30% for a short period of time. We're going to see here, in part, this is one of those points about that impact of the longer we're shut down, the more impactful it is. Wanted to take a moment here to talk about price to earnings ratio as a driver of the S&P 500 pricing. This is an important point here. Not to get too complicated, but basically one of the underpinnings of where stock prices are is a multiple of the expected earnings per share of the 500 companies in the S&P over the next 4 quarters. And prior to where we were, in February, prior to the turn down, the expectation for the coming 4 quarters for earnings per share was about $176.76, suggesting that at the peak, when the S&P peaked on February 19th, the forward price to earnings multiple was a shade over 19 times. You can see the long-term average is about 16.2, 16.3 times, and so markets were fully valued, certainly, not way out of historical averages, but you can see certainly during the dot-com crisis they were much higher than that. But yeah, fully valued. One of the things that's difficult when things are changing as quickly is to get a new consensus on what the forward expectations for earnings are. But even if you put a substantial haircut on earnings, down 11, 12, even 15%, it would suggest that where we got to in the S&P 500 on March 23rd was perhaps pretty lowly valued. That in fact the market was pricing in a really pessimistic scenario. And since then, we've had all news that's been either at or better than market expectations. And so given a rapid pricing in of really bad news to March 23rd, that suggests earnings were dropping as much as 21 or 22%, in the coming period. That seems pretty aggressive, that earnings would drop that quickly. And so given the Fed coming out with the, whatever it takes, and the central banks across the world doing the same, and the U.S. government dropping big programs to support the economy, and then flattening of the curves with the coronavirus, and expectations that perhaps this is not going to be the zombie apocalypse that we feared it was in mid-March, there's a recipe for a bounce, which is what we've seen. Now, there's some thinking that perhaps the market has responded too quickly and come back a little bit too aggressively. And we do think volatility is going to be the order of the day going forward. The current valuations around 2,800 may in fact be a little rich. But the other thing to keep in mind is that everywhere else in the world is impacted as well. And so the attractiveness of the S&P 500 and U.S. stocks is not in a vacuum, but also given every other place that investors could put their money. And there are similar impacts across the globe. And so therefore, it's not just what's going on in the U.S. that are scaring people off, but what's going on everywhere. Traditionally, the U.S. has often been a safe haven, and it may be the case that U.S. stocks are going to serve in that role to some regard as we go forward. Certainly, government treasury type bonds are not very attractive given the extraordinarily low interest rates that are available right now. So we are looking really closely going forward at S&P earnings, moving from that $176 per share that I mentioned was the estimate in February of 2020, looking like the next 4 quarters could be at $156, so about 11.6% decrease. Possibility that will be downward adjusted a little bit going forward, depending again on the length of the shelter in place and how quickly we're able to get things back up and running. So, just a quick thought on behavioral finance here as we sort of see ourselves bottoming here in Q2 and the early part of Q3, and then a recovery period going forward. All of our best research would suggest that investors are served by staying in, right? If you look at 20 years annualized returns from 99 to 2019 for the S&P 500, 6.1% per year, 60-40 split between equities and bonds, 5.6, just a little bit less than what the S&P did over that 20-year period. Average investor over here on the right in orange, only 2.5%. Best that we can see is the primary motivation for that is the tendency of individuals when markets get jangly to want to sell and go to cash in part or in whole and take some risk off the table, effectively selling in low spots, and then when the market feels good and is moving up, wanting to get back in after lots of the good things have already happened and effectively buying high. We think it's one of the best reasons to engage an advisor is that an objective investment professional who you trust and have a relationship with can help you avoid making emotional decisions when markets get jangly. And that's one of the things that we've been doing for our clients here in the last several weeks is just sharing with them our perspective, reminding them that our best research suggests that it's extraordinarily difficult to pick the high spots and know when to get out. And then also pick the low spots and know when to get back in. Having sat in this chair working with clients over the last several weeks, I can tell you extraordinarily difficult to know, oh, this is the low spot, let's put money back to work. Really hard to know that. It's, always a conflicting set of information, always some perspectives that, more bad things are ahead of us, and at the same time, perspectives that always bouncing back. And so our best advice is to stay invested, to weather the storm over 3, 5, 7 year longer term pictures. Folks who stay in continually do better than folks that try to go in and out. One of the things that we have seen repeatedly is that the best days in the market often follow closely on the heels of the worst days in the market. And that's certainly been the case here. We had big drops leading up to March 23rd, and then some pretty significant up days in the weeks right after that. To get that 6.1% that the S&P earned here over the last 20 years, you have to be fully invested. But if an investor missed the best 10 days, which again are often on the heels of the worst days, that 6.1% return drops to 2.4. If you miss the best 20 days, you basically break even. And so you're getting out when things are feeling terrible, and then being on the sidelines in harder and whole when the rebounds happen, often on the heels of the downward drops, can effectively vaporize an investor's ability to realize the return. So I wanted to close with that, and just some thoughts on business investing versus personal investing, and then we can open it up for questions. When we work with clients on an individual basis, we're often working with money they're saving for the long term, for retirement, and to last them through the end of their lives. When that's the case, and especially if there's some dollars there, some assets that we're working with, we can afford to take a longer term perspective. We can afford to take the perspective that we don't mind if we get some downturn in the short term, as long as we feel confident that we're going to get that long term, like you see on this slide, S&P 500 return of 6.1%. No guarantees that that'll happen, but over time it's proven that equity markets tend to take up despite the volatility like we're living through now. And so for long-term money, we can take that risk and feel pretty comfortable, as long as the client's risk tolerance is such that it doesn't prevent them from sleeping at night. We can have a little downturn before along the way, as long as we're confident it'll grow over the long term. In the case of business assets, the perspective can be a little different. What we often do for clients that have cash in their business or assets that they can invest that they don't need for working capital is to split it up into some different pools. And so we'll have one pool that that we say to them, hey, keep this in your bank. This is your short-term working capital. And then another pool that we don't necessarily need in the next weeks or a month or two, but we might need it in the next 12 years. It's sort of our emergency fund, and we'll hold that in an account that invests in a money market fund. And it's basically liquid, but doing a little bit better than what their bank is paying. Maybe we'll have some short-term, short duration, low-risk bonds in the mix as well, and effectively have a tranche of dollars that are invested conservatively that is unlikely to be down in any given moment, but have just a little bit better return profile than what the bank can pay them. And we'll often have another tranche layered right over that that's conservatively invested, has some equities, but also some bonds and cash. And that's sort of their medium-term money, money they don't expect to use in the next 1 to 3 years, but maybe over the medium term. And then perhaps one more tranche invested over the top that's for the long term, strategic money for 5, 7, 10-year or more perspective that can afford to act like that personal money that I mentioned at the outset of this part of the conversation. And that's an appropriate way for clients that have business assets to manage to handle risk. And so we often have conversations with clients about how to structure that that's right for their needs. When you're running a business, you don't want to be putting dollars you might need for payroll and near-term capital expenditures and pay the rent or the taxes. You don't want to be putting that at risk. And so we often work closely with clients to help them think about that for their personal dollars and for their business dollars. So with that, Stella, covered the basics here. Again, some disclosure information. And then just wanted to leave my contact information there for folks. You can get a hold of me at Nathan@DBV Wealth if you'd like to follow up and ask some specific questions, and then we can open it to Q&A.
Nathan, thank you so much for such a thoughtfully presented webinar. I really appreciate all of your insights here. We don't have any open questions right now, so if you have questions that you've brought with you, can you start with that?
Yeah, absolutely, my pleasure. So I've got a few questions that are common from clients at this time, and so I just thought I'd share a couple of pieces of perspective, and then we can wrap up. One of the common questions is, if you think there's still going to be lots of volatility or downturn coming, why don't we get out in part or in whole and then try to get back in after the downturn? And I think it's a reasonable way to think, and it's a reasonable question to ask. The challenge with that is that we end up in a situation where we're trying to anticipate when is the moment to do the getting out, and oftentimes waiting for a little bump or a little high in the market, and then say, okay, here's a good time to exit, and then hoping that the market doesn't continue to go up right after that moment. We've missed out on that, and then presuming that we're correct and there is a downturn, or in this particular case, let's say late in February, we're starting to see it go down and expecting it to get worse, and we're going to try to move out of the market. Well, oftentimes the stock market is a leading indicator of the good news being established on the ground, right? The minute there's a glimpse that that things are perhaps not as bad as we hoped, the market is oftentimes rebounding and shooting back up. And we certainly saw it in this circumstance. Before there was broad consensus that we had glimmers of hope and light at the end of the tunnel on the coronavirus, or on the markets on the economy, we were already seeing rebound. And on March 23rd, the last big down day, was feeling pretty terrible. We saw the recovery start. Very difficult, even as someone sitting here all day, every day, working on this, and our investment committee working on this, to be able to say, yep, now is the moment. Let's bet all of our clients' dollars that just went into cash a month ago and put it back into the market. Possibility that there still could be a downturn. And so again, if clients have a little dry powder that they've been sitting on in their bank accounts and they want to send it to us to try to put it to work in a moment of relatively cheaper pricing, we certainly encourage that. But as it relates to the individual dollars, the existing dollars that are invested, our best advice and all of our research shows that the best returns are associated with just hanging in there. A second question that we get quite a bit, I just wanted to touch on, going forward as this economy reopens in phases, what are some thoughts on areas that are likely to do well and some areas that are likely to struggle? And how do we get in position to participate in that? And I think that's a really smart question. I want to provide that same caveat that it can be difficult to predict exactly how markets are going to behave. And things that seem like obvious winners, may be the case that much of the good news and much of the stock appreciation has happened already. And in other cases that that we think are going to be tough sectors and are going to be struggling to come back online, it could be that the share prices at the moment are already pricing in a lot of that downside scenario, and so going forward there's very little room to move except up. So I just want to offer that caveat. That being said, we've seen performing well through this downturn and expecting to continue to do well going forward some sectors that are related to online entertainment, certainly e-learning, distance learning, and the ability to deliver learning and knowledge through the internet, wireless infrastructure, and anything related to building cell phone towers or 5G stations, and the ability to make the internet flow better, the plumbing of the internet. We expect that to continue to be strong. Same for cloud computing and server farms in any business that's building or investing in well established cloud firm computing server farms. We expect them to be in a good position. Certainly businesses that are in shipping and distribution, we continue to see consumer behavior moving to online purchases, and so businesses that are working to deliver packages and have online models are going to do well from our thinking. Telemedicine, really interesting and emerging field that I think is going to get a real boost out of this circumstance here with coronavirus. Also, personal shopping, really interesting. The idea that you can, potentially use somebody to make purchases on your behalf and potentially businesses that combine personal shopping with delivery method. Still some things to be worked out in that space, but interesting going forward. Things that we think are going to be slower to respond coming out of the the phased reopening the economy. Certainly anything with live entertainment, it's going to be slower to reply to respond. If you're counting on tens of thousands of people being together in a tight space, that's going to be slower. Certainly the cruise industry, imagine that their traffic is going to be impacted. Airlines and therefore hotels probably be slower to rebound. Also, brick and mortar retail businesses that don't have an online component, we think they're going to struggle. That was happening already, and we think this will accelerate the trend. So, one of the things that we're looking at is the use of actively managed mutual funds versus passively managed funds. I'm not going to get into the space of making recommendations here or talking about any funds, but from March of 2009 to date, passive index funds that own entire sectors of all the sectors of a particular asset class have done pretty well, as most things have been on the rise. Going forward, it might be interesting to have a little active in the mix, and that's something that we're looking at carefully. I wouldn't throw it out there that carte blanche active is going to do better than passive going forward. That wouldn't be a reasonable conclusion to draw. Certainly, it has very much to do with the particular asset class and also any particular mutual funds decision-making process, talent, incentives, research bench, all the things that we look at very closely when we decide which funds to work with. But interesting to consider active who may be doing some work to ferret out the sectors of the economy that are performing well coming out of this, trying to evaluate those and see if we can't get in a position to participate. Stella, with that, I think I'll wrap it up unless we've had any questions pop up.
No, we're good. If you can move to the last slide.
Absolutely, my pleasure.
Again, thank you, Nathan, and thank you for everyone that has joined the webinar this morning. I really appreciate you taking the time out. Next week, we're going to have Kurt Rocca presenting on Beyond the CARES Act and PPP, financing options for family businesses. He's going to provide an overview of government and non-government financing sources to help family businesses weather the current COVID-19 situation, as well as ways to capitalize on the inevitable opportunities that will arise once this is passed. So check us out next week. We'll be sending out information about that shortly. Also, for this presentation, Jennifer's going to be sending out a follow-up email with the PowerPoint attached, and then shortly we'll be able to put this webinar on the website so that you can look at it later, or as come back to it, or share it with anybody that you think this webinar will benefit. And with that, thank you very much.